Right, so what we're going to talk about in this section is Forex jargon. Now, you may have been watching a couple of the videos of this course already and have come across a few words or a few terms or phrases that you have no idea what we're talking about, okay? And I'm sure as you go through the course as well, you might find some more words and phrases that you haven't heard of before, okay? And this is basic Forex and trading terminology. So you need to be familiar with these terms because this is how we talk when we're trading. Okay, when we're looking at opportunities and we're seeing certain things happen on charts, okay, we need to be able to understand the terminology and what actually is the meaning behind this terminology. So in this chapter, I just wanted to cover a few of the most important ones, okay, so most important ones that we'll actually come across in the course, just so that you have a full understanding of what we mean. So first of all, the quite simple, obvious one is trade and trading. Okay, so trading obviously means to speculate on the direction of the market. So actually to make a decision on whether or not a market should go higher or lower. Okay, and therefore as a trader, what we would do is buy or sell that market. Okay, if we think it's going to increase in price, we would buy it. If we think it's going to decrease in price, we would sell it. Okay, and obviously our aim as traders is to profit from that movement. The next one is Forex. Okay, so Forex is short for foreign exchange. Okay, it is the exchange of one currency for another currency. The example we used earlier in this course is basically if you were looking at going on holiday from the UK and you're heading to the US, what you'll be doing is transferring your pounds to dollars. Okay, so you have have dollars to spend when you get to the US. It's exactly the same. It's just in terms of multiple different currencies. So we look at pounds, euros, dollars, Swiss franc, Aussie dollar, New Zealand dollar. There's so many different currencies that we will use when we trade, and what we're doing is we're trading the difference in price between those, and obviously speculating whether that price or that currency will strengthen or weaken compared to another currency. We then have market. So in terms of finance, a market is where people trade financial instruments. Okay, so these financial instruments could be anything from CFDs, which include Forex, spread betting. We then have derivatives, things like options, futures. And then also we have stocks or shares. Okay, stocks is the name for US companies, and shares is the name for UK companies. Okay, obviously what we're focusing on is Forex, which will primarily be CFDs or spread betting. We then have the broker, okay, the brokerage company. So basically for every single buyer out there, okay, so if for example I wanted to buy a stock in Apple today, someone has to sell that stock to me. So for every buyer, there is a seller. Okay, and to arrange that deal for enable me to actually buy that stock from another individual. Okay, there needs to be a broker. Okay, a middleman, and therefore this is the company. Okay, and the platform that we use that allows us to trade these kind of markets. Okay, and obviously as you guys now know, we use XM as a broker. Okay, and there's some links for that later in the course. And XM is our broker, XM is our middleman. They provide us with the market to trade, okay, and they also provide us with the prices at which we can buy and sell at. Now, they also have a software which enables us to actually place these trades, and this software is called MetaTrader 4, okay, MT4, and it's available on your phones, okay, and your laptops as well. Charts. So charts are the way that we view a specific market. Okay, so we can see the price, we can see the price action, and on charts we can start drawing our technical analysis on as well, to actually analyze these markets and actually see and predict where that market might be moving next. Okay, we can also see historically what's happened on that market. So we can see over the past 10, 20, 30 years what actually has happened in that specific market, whether it has risen, whether it has fallen. So we can look at historical data on these charts as well, for the specific market that we're actually focusing on. We then have leverage. Okay, leverage is quite a confusing one to get your head around. It doesn't matter too much. Okay, what it's most important for is in terms of the margin in your account, which I'll talk about margin after this. Leverage is basically the term used for the amount of money you're able to control when trading. So if for example we had 100 to 1 leverage, okay, and I deposited $1,000 into my account, technically when I'm trading, okay, I'm trading as if I have $100,000, okay. So what that means, I can control a larger amount of that currency. So if I'm speculating that it will rise, and I get that correct, it means my profits will be maximized because I'm trading as if I have $100,000 as opposed to having 1,000. Now, what you do have to remember that obviously the higher leverage you have means higher risk, okay, and obviously a smaller movement in the currency when you have higher leverage actually has a large impact on your account. So obviously profit can be maximized, profits can be increased, but also so can losses. And that's why it's very important we look at stop losses, which we'll talk about later, risk reward. And that's why it's very important to just ensure that you understand the leverage on your account. So margin, as I mentioned, so margin obviously kind of goes in with leverage. And what it is, it's the amount of money that's held with a broker to open your position. Okay, so the broker will hold an amount per position, okay, that you open. So if, for example, I'm trading GBP US dollar right now, what they'll do is as soon as I place that trade, they will hold a certain amount of money, okay, and that depends on the leverage, okay, that you've got on your account. So for example, why do they do this? If I was to lend you my car for 24 hours, okay, you would want to give me something in return just as a guarantee. And also I would want something in return as a guarantee. So maybe that could be in terms of a deposit, okay, in case of any damage. This is exactly the same in terms of the broker, okay? The broker wants to protect themselves just in case there's any adverse movement in the market. And therefore, what they'll do is they'll hold a certain amount of your capital just to take that position on, okay? And that amount is also static. So obviously, if you place a trade and they've taken a margin of $200 on that trade, then obviously as soon as you close that trade, whether you're in profit or loss, that 200 will be released back to your account. Now, you've probably heard us say long or short. Okay, so first of all, just starting with long. Long is the same as buying. Okay, speculating that the market will rise and therefore the price of that market will increase. So if we ever say, right, we are going long of GBP USD right now, it means we're buying. It means we think the market should be increasing and therefore the pound should be increasing against the dollar. Vice versa, we have short. Okay, short is the same as selling a market. Okay, speculating that that market will fall and therefore speculating if it was GBP US dollar and we were shorting it, speculating that the pound will decrease in value against the dollar. Stop losses. So obviously, with regards to trading, we want to make sure that we're protecting our capital as much as possible. Okay, and this comes in terms of stop losses. So a stop loss is an order on a market that we place to protect our trade should we get the direction wrong. Okay, so if we're going long of a market, okay, and our target is 50 pips, we might turn around and say, right, okay, we want to have a stop loss at 20 pips. And if the market falls by 20 pips, we're going to come out of that. We're going to accept our loss. And the stop loss will do that for us automatically. Okay, so it prevents us from losing more than we want to if we get the trade direction wrong. Okay, and just bear in mind, we will get it wrong sometimes. Okay, we won't get 100% of our trades correct. There will be trades that we get wrong, and obviously managing that risk, okay, and putting stop losses are very, very important as a trader. On the opposite to that, we have take profits. Okay, so this is essentially our target price for the trade. Okay, so again, it's set up at the beginning when we actually place a trade. We set our stop loss. Okay, we set our take profit, and then we execute that trade. And what that does then, it will automatically close our position when we reach that take profit area. Okay, so if we have a take profit at 88, the market, as soon as the market reaches 88, will automatically take our profit and close that position. So risk reward we talk about in a lot more detail later on, but basically it's the amount of financial risk that you are willing to take on a market or on a trade, okay, compared to the amount of potential reward that you're targeting on that trade. So if we're risking $100 on one single trade and the profit target is $200, let's say, that would be a risk reward of 1 to 2. Okay, and as traders, we want to make sure that every trade that we're taking is going to be above 1-to-1 risk reward ratio. It's very important. We'll talk about it later as to why it's so important, but just bear that in mind. We then have the terms such as bullish, bearish. Okay, bullish is just a term for a market that's moving upwards. Okay, the price is increasing and there's buyers controlling that market. So when we say the market is currently bullish, it means the market is going up. Okay, if we're saying that we're bullish on this market, it means we believe the market is going to go up and the price will increase. Alternatively, we have bearish, okay, completely opposite. It means that there's sellers controlling the market. It means that the market is moving downwards and therefore the price is decreasing, okay? So obviously, if we're bearish on a market, we believe the market will be going down. We then have trending, okay? So trending is basically when the market is moving either bullish or bearish, okay? Either up or down. Okay, very, very simple. The market has three kinds of movements, and I'll talk about the third one in a moment. But we have a bullish movement, okay, an upward movement. We have bearish movements, okay, a downward movement. And then finally, we have what we call consolidation. Consolidation is when the market is moving sideways, okay? It's not trending, okay? It's not going up, it's not really going down. It's having a breather, okay? And this is consolidation, okay? Some people call it a ranging market, okay? Exactly the same thing. And what I see consolidation as I see the market is slowly building pressure to trend again. So it slowly builds that pressure while it kind of just relaxes, takes a breather, and then obviously that new direction of bullish or bearish will then come into play once that consolidation has completed. Now, timeframes we will speak about a lot, and I know we've spoken about already in this course. Now, what this indicates is the amount of data that we see on a chart. Okay, so any time frame from monthly to 1 minute can be seen. Okay, even 1 second actually can be seen, but you don't want to worry about the lower time frames too much because there's not enough data in there. Okay, but what it means is how much data we can see per candle. And by candle, I mean Japanese candlesticks, which again we'll talk about later on. So if I've got a monthly time frame, it means that each candlestick that we see is 1 month worth of data. Okay, so 1 month's worth of buys and sells in that time frame, in that candle. Okay, so it means that obviously if we have a whole page and we can see all these candles, we're going to see years. Okay, obviously the bigger time frame that we view, the more accurate the signal and the information that we're seeing will be, simply because there's more data. Okay, we have a larger sample size, therefore we have more information, and more information means more higher probability that what you believe is going to occur will occur. So just in terms of time frames, just remember that the monthly time frame, the weekly time frame, the daily time frame will be a lot more accurate when you're looking at certain signals as compared to the 1 minute time frame, the 5 minute time frame, the 15-minute time frame, okay, even potentially the hour time frame. Okay, and all it means is just the amount of data in the candle. So an hourly time frame will give us an hour's worth of data per candle. We then have reversals and retracements. Okay, this is where the market changes direction. Okay, we move perhaps from bullish to bearish. Okay, so for a period of time we might move up, and then that market has now changed, and therefore we might move down. Okay, a reversal is a longer term change of direction. So a retracement is kind of like a short term pullback, what we call. So the market might be bullish for a certain period of time, and then what we'll do is we'll see a pullback. Okay, and this is a retracement. The market will pull back. Okay, the people in the market will start taking profits, and therefore the market will go down. But then eventually the market will continue its original bullish move. Okay, when we talk about reversals, we mean that there's actually a full-on change of direction. So we have headed up for a long period of time, and now we are in a reversal, and therefore we are now heading down. Okay, for a longer period of time. Now, when we mention rejections, what we're talking about is where the market fails to climb higher or fails to fall lower. Okay, so there will be certain prices, certain barriers where the market will get to and it will reject. And this just means that it can't push higher than perhaps that price or can't fall lower than that price. And therefore it will change direction. Okay, it will reverse or potentially retrace. We then have the bid, the ask, the spread, and the pips. Okay, I'm going to leave this one because I have a video explaining all of this later down the line. But the bid, the ask, and the spread are basically just in terms of the pricing of a currency. Okay, and the pip is actually how we measure the movement in that currency. But I'll leave this for later on in the course because I've got a full run through on the drawing board for this one for you. We then have support. Okay, so support is basically the area or a barrier below the current price. Okay, this is what we call our floor. Okay, and this barrier can act as a point where the market may reverse or retrace. Okay, we cover this in full later on. Okay, we then have our resistance. So this is the area or the barrier that we have above the current price. Okay, it's the ceiling. So this barrier again will act as a point where the market may reverse or retrace. Okay, and as I mentioned, we'll cover this in full detail later on. We then have EMAs. Okay, so EMA stands for exponential moving average. Okay, the average price of a market over a specific period of time. So what this does is it plots out a nice smooth line on a chart for us to see. So we can see very obviously whether we're in an uptrend, whether we're in a downtrend, or whether we're in a sideways consolidation. Now, Japanese candlesticks, okay, this is the way that we display price action on the charts. So we can actually see the buyers, we can see the sellers, and we can see who's stronger, and we can see what's potentially happening to that market and what potentially could happen next. I will talk on this in so much detail later in the course, but just to understand Japanese candlesticks are the green and red bars that we've already introduced to you. And it allows us to actually read the price action and anticipate the next movement on a market. We then have Fibonacci. Okay, so Fibonacci is a tool that we use to measure retracements. Okay, we'll teach you how to do this, how to set it up, where to kind of try to identify these kind of areas. But what they do is they basically provide us with an area where we can already predict where the market might turn. Okay, where the market might turn and retrace. So we'll cover this one later as well. And that completes it for now. Okay, so hopefully I've covered some of the main ones that we've spoke about already in this course, and then also would have covered some of the ones that we're going to be talking about further on in this course as well. And obviously, if any of them don't make sense to you, just a quick Google search, for example, will help you just understand the meanings behind them. But don't go any further than the meaning behind them. Don't try to find more information online in terms of how to use them. That will all be in this course, which we're obviously excited to talk to you about later on.